Broker 2021, and of course, Nigeria 2022. And so I have been invited to come and talk a little bit about some financial concepts that, really affect a majority of us. So today we're going to be talking about the rising cost of living and what can one do to try and manage that. But I think before we can even start, it is important for us to truly understand what causes the rise in the cost of living. So you and I are ordinary people, and what we would do is we would go into the shops and buy goods or services, right? The more those goods and services start to have an increase in terms of how much they are priced at, you will start to see a disparity between the income that you get or the income that you can derive versus what is your buying power. So how much can you actually purchase for the amount of income that you are receiving on a month to month? So that's what we're wanting to talk about. We're going to talk about what are some of the factors that come into play when we're talking about the cost of living. What are some of the factors that are driving this increasing cost of living? We saw as the global pandemic hit us 2 years ago that a majority of our economies across the globe had to go into a slowing down. So economies were slowing down, which meant that there was not a lot of economic activity. And potentially because of that, it meant that the supply of certain goods and services was also slowed down. One of the big industries that got hit was the airline industry. And what you would have noticed is that a majority of the airlines, because they had to ground their flights, they were actually in a very sluggish revenue or profit making space. And that is part of how that in itself, the demand was not high, the supply was there, but because, of course, of the circumstances that we're in, they could not fly, right? So the demand was still there, but the supply was low. So all of these things can potentially have an effect on how the economy is actually going to grow or how the economy is going to perform. But I want to get into a little story in my own personal life. So when I think I was 9 years old in 1997, yes, I'm showing my age, my sister and I, Bridget, used to live at a home that my father had obviously lived with us. But we would walk to school, and every single day my father would give each one of us 5 rand, 5 South African rands. This is like back in 1998, if I remember correctly, not 1997. 1998, I was turning 9 years old. My dad would give us 5 rand each, and each day he would say to Bridget and I, you must leave 1 rand 50. So the 1 rand 50 basically is you can spend 3 rand 50 on whatever you need, but 1 rand 50, you need to leave 1 rand 50, and your sister needs to leave 1 rand 50, and the 2 1 rand 50s would make 3 rand. And with the 3 rand, we were then able to buy a loaf of bread. So you can imagine that all those years ago, back in 1998, we were able to buy a loaf of bread for a mere 3 rand. If you go, for instance, on one of the grocery apps currently in South Africa, the one that I use quite a lot is called Zulzi. Now on Zulzi, a loaf of brown bread is 17 rand. So the difference between how much bread was in 1998 and how much bread is currently right now, that increase is basically what we call inflation. The prices of goods or services have gone up, and that's essentially what inflation is. And it's very, very easy to be able to demonstrate inflation basically from everyday products, everyday uses of products and services. So you can imagine right now, if you go back to 1998 and you compare the price of a doctor's consultation versus how much a doctor's consultation is today, you will start to see that there's been an increase in that price. So a lot of the goods and services that we're able to enjoy today have had to increase their prices so that they are still able to make a profit. So, for instance, let's talk about something that would need to be manufactured. Let's say you are buying a wooden table with 8 chairs. If in the olden days, the raw material of the table and the chairs, so we're talking about the wood, we're talking about the cushions, we're talking about the material they need to use, we're talking about the stuffing, we would talk about these being input costs. that you have to consider so that you are able to price this set that we're talking about. Depending on the cost of all of those raw materials and your labor and your time, you would come up with a price, right? Now, what we're saying is, because the changes have happened over the years and there's been adjustments that have happened in the cost of production of this wooden table and its chairs, it means that the price you're going to pay today is probably also going to be adjusted based on the inflation rate. So what is inflation then? Well, the definition of inflation, according to the Monetary Fund, right, is inflation measures how much more expensive a set of goods and services has gone up by over a certain period of time. And it's usually a certain period of time, which is usually a year, right? Now, this definition comes from the International Monetary Fund. Another famous example that I love to use to be able to demonstrate this, if you remember the Chappies bubble gum that we used to love eating, it had an ad that used to go, Chappies bubble gum, I can't remember, energy, energy, energy. So that is the product we're talking about. If you remember a couple of years ago, that little piece of bubble gum, those little squares used to cost you like 10 cents, worst case scenario. Now, majority of the shops, you don't really find them in individuals. But if you do go into some of the smaller towns, you may find a little jar in one of the little cafes or at the forecourt, and they will be selling those at like R1 for each. That is inflation in action. And it's important that even when you're thinking about inflation from not necessarily just a cost of living, but from an investment perspective, a savings perspective, it's important to remember that you are trying to beat inflation at all times, because inflation basically is like the erosion of the value of your money. So what you were able to buy with R100 back in 1998 in terms of bread will look different from what you're able to purchase in terms of bread quantities in 2022, right? Or 2022. So that is basically what we're talking about. So I always use this example and I say, if you are trying to beat or find the best savings mechanism and you need to beat inflation, you've got to factor in all of the fees that you're going to pay. So let's assume that inflation is sitting at 6%. That's quite a high inflationary rate, right? And this is inflation. This is the money you are saving. So essentially, when you get to the finish line, so let's say we're running the 100 meters. The one athlete is inflation. The other athlete is your money. Now, inflation is at 6%. Your money needs to cross the finish line and earn an interest that will be higher than the 6%. Because it would not make sense for you to keep your money in that specific account if it does not beat inflation. Because it means that if you put away R100 today in an account that does not beat inflation, if your money and inflation cross the line, essentially your money will be less valuable than on the day that you put your money in. So this is something to keep in mind in terms of what inflation actually is. But what causes inflation? There's 3 different causes that one can look at when we're talking about the causes of inflation. The one is called the demand pull. The second one is called the cost push. And the third one is called inflation expectations. So let's start off with demand pull. What is demand pull? Well, essentially, when we talk about demand pull, we talk about when goods or services or the demand, the need for them, is rising faster than the supply that's available in the market for those goods and services. This results in us having a demand pool of inflation. But what do we actually mean? We're talking about, for instance, if let's say coming out of 2021, we saw from the beginning of the year up until we are in now in South Africa, there's been an increase by the Monetary Fund policy or the Monetary by the Monetary Fund Committee, there's been an increase of our interest rate. So in other words, if you are on a flexible rate and you've bought an apartment, let's say a 2-bedroom apartment, right? And you were paying 8,000 Rand in the beginning of the year, potentially by now, you could be paying something around probably 11,000, 5,000, right? Let's say that a majority of people struggle with paying. So then there is an influx of apartments in the market, right? If there's an influx of supply in the market of two-bedroom apartments, you would essentially get what is called a cost push inflation. But right now, we're trying to demonstrate what would look like a demand pool. So the inverse of that would create a demand pool. So let's say, for instance, the Monetary Committee Committee decides to lower the interest rates in the next year, it's not possible. There is actually a projection of having the prime lending rate going all the way up to 11% in the beginning of 2023, but yet we are yet to see what will actually happen. But I want you to imagine in 2023, the prime lending rate drops. So it becomes a little bit more cheaper for us to be able to access credit amounts of money or credit facilities, right? Especially if you're on a variable rate. So now all of a sudden what happens is that there is a very big demand of people who can buy two-bedroom apartments because they can get access to home loans. But the supply of two-bedroom apartments, because those who have two-bedroom apartments, it's cheaper for them now to actually keep those apartments, so they're holding on to their apartments. So the aggregate demand is staying slightly, right, increased, but the supply is staying low. Or in actual fact, in some cases, people are not letting go of their apartments, so actually the supply is decreasing. Now, when we find that the demand, or the supply rather, is not meeting the demand that's in the market, what happens is that the prices of goods and services are then pulled higher. Okay, let's start again. Avocados is another one of my favorite examples. Now, we know in South Africa there's what is called an avocado season. Now, the big provinces that produce avocado is generally your Mpumalangas and your Limpopo province, right? So, generally, in the avocado season, there is a lot of supply in the market of avocados, right? So, you may find that prices are staying steady because there's quite a number of supply. Sometimes they even can cause a cost push inflation because the supply is quite high and the demand is not meeting the supply, right? But in a case where we're out of season of avocados, and the guys in Mpumalanga and Limpopo are the only people that have supply to avocados, but the rest of South Africa is in dire demand of avocados. And that supply that is available in the market from Limpopo and Mpumalanga is not enough to cater for all of the other 7 provinces in the country. You get what is called a demand pull inflation because the prices of avocados are going to get pulled higher. So that's basically what demand pull is, right? Now, it's very important to understand the law of supply and demand because if you understand the law of supply and demand, it's easier for you to understand why there would be an increase in prices when there is a shortage in supply but a higher demand, right? So if I am the supplier and you are the one who's demanding, and there's more of you demanding, generally, I, as the supplier, I can actually increase my prices because it's a matter of highest bid, who's going to take, who wants it bad? You know what I mean? Okay, so let's then talk a little bit about what cost push inflation is. If it so happens that in that avocado scenario, the supply is what we start to run out of first, right? So we're starting to run out of the supply of actual avocados, right? And that means that the guys, again, who have the avocados themselves, they start to feel that, okay, we may need to increase our prices to cover the higher demand or the higher cost of actually getting avocados into the rest of the country or even the rest of Africa. That's when you get what is called a cost push inflation. So we saw this happening, for instance, with situations where crops go through a supply shortage. And then the production of producing more crops becomes higher. It means that there is a cost push inflation. The cost of production, the cost of making this good or services available to the market is what is pushing the actual price of the good or service, right? Then there's what is called inflation expectation. And now inflation expectation generally falls into what is called inflation psychology. So it said that if the market itself or the companies themselves are expecting an inflation adjustment. So, for instance, they can already foresee that there's going to be a shortage, for instance, in the supply of certain goods or services due to a natural disaster, of instance. It means that it's going to increase the cost of production. So, therefore, they already adjust the prices themselves and actually almost allow the prices of goods and services to play into what they already expected. So it's almost like a self-fulfilling prophecy that happens because these guys already had expected, they had psyched up that there is going to be an inflation, right? So they already adjust prices based on an expected future inflation. So that's basically what inflation expectation actually is. I'm hoping that you guys are having a good time and understanding all of the stuff that we're talking about. And it would be very interesting to know what are some of the goods and services in the economy that you are in, or if you are watching from South Africa, what are some of those goods and services that you remember from a young age that when you look at the price right now, you're like, man, the prices here have really increased. Or maybe we look at it the other way and say, what are some of those investment or savings accounts that you have that always beat inflation, and what is that inflationary rate that they're managing to beat, and what is your interest rate that you have received from the actual company where you are invested? All right, so how do we then measure inflation? There are three ways in which we can measure inflation. The first one is through the Consumer Price Index. Now, with the Consumer Price Index, basically, we're measuring the prices that consumers pay for goods and services using a basket of goods, right? So there's 8 major categories in that basket. It is food, beverages, apparel, which is clothing, transportation, education, recreation, medical care or health care, and other goods and services, right? So we take those and we put them in a basket and we measure the price changes for those types of goods and services. So that's basically what we're looking at, right? Then the next one that we can look at is what is called personal consumption expenditure. And when it comes to personal consumption expenditure, it is tracking the prices that businesses receive for goods and services rather than focusing on this basket that we spoke about earlier on with the 8 different categories of goods and services that we actually measure. Now, the personal consumption expenditure is often seen as the more real way of actually measuring inflation, if that makes sense. So, at its core, the personal consumption expenditure is how a lot of central banks prefer to measure inflation because it also allows a broader range of goods and services that are being purchased. And I'll tell you why. A majority of us don't live the same quality of life, right? So, for instance, my basket that I would measure on might not necessarily look the same as the next person's basket. So we always talk about what is real inflation and what is a general inflation. So you may find that the CPI, it measures quite a general basket of the everyday man. Whereas the personal consumption expenditure kind of even looks at what the wealthy, the poorest of the poor, the middle class, the working class, what all of those people will have in their specific basket. So that's basically what it is. And that's why I say a lot of the central banks prefer this method of measuring inflation because they feel it's like at its core a more realistic view of what inflation potentially could look like in a specific economy. And the last one that I want to speak about, of course, is the Producer Price Index. Now, the Producer Price Index measures prices that are received by the domestic producers for their output, right? So as as a producer, what is the price that I'm receiving? So if I produce, for instance, maize meal, what is the price that I am receiving when I'm actually, I'm selling these off to my retailers, my wholesalers, right? Because you must understand that when it comes to producers, there are a number of things that they are going to take into consideration when they have to price. Remember when I spoke a little bit about you are about to produce or buy a wooden table with 8 chairs. So you've got to look at the raw materials, whatever other components they are, the labor, sometimes storage, sometimes shipping or transportation of the finished goods. So the price that they get when they sell off that final product, that is how we're going to measure inflation. So it is through the PPI, which is the Producer Price Index. Right. Let's move on to what we want to talk about today, which is the rising cost of living and what inflation as a measure or a factor on the quality of life, the cost of living, and how inflation actually has an impact on that. One thing we can never run away from is the fact that the moment prices go up, the moment prices of goods and services go up, it also means that the cost of living has gone up. And I use the example to say, generally, if you look at salary increments across different industries, it is almost often never in correlation to how much things are. So we're talking about food, we're talking about transportation, we're talking about education, we're talking about healthcare costs. Those things generally do not keep up, or the salaries themselves do not keep up with the cost of those things. So ultimately, because these things also come from a producer, a manufacturer, now when the prices of production or producing these items goes up, it means that the companies that are the ones that are manufacturing or producing, they also then experience an increase in the cost of production or the sale cost. So they have to make sure that they react to that inflation by puffing up their prices so that they pass on the cost, this new added cost, to the actual consumer. So the reason why the cost of living then goes up when inflation goes up is because there is a real cost that is passed on to the actual consumer from the producers and the manufacturers. But what is then the relationship between inflation and the interest rate? So now we've dealt with the one part, the relationship between inflation and the pricing, right? We know that inflation and pricing will increase the cost of living. Now, as I said, we've seen throughout the year that the interest rate has been adjusted quite a number of times. And there's actually such a very close relationship between inflation and the interest rate. What you will find is that it mirrors a basic supply and demand principles. What do I mean by this? Whatever happens, if there is a cost push or a demand pull inflation, you will actually see that because these are the laws of supply and demand, it's often the same relationship that will exist when it comes to interest rates. Because interest rates and inflation tend to move in the same direction, one chasing the other. So when the one goes up, the other also goes up. And let me demonstrate it to you. In January 2022, the South African inflationary rate was 5.7. This is January 2022. 5.7% was the inflation rate in South Africa. The interest rate on the other side was 7.5%. Right? Then what happens? Inflation rate increases. So the cost of goods and services increase. Then in July, when the inflation is measured again, the inflation is sitting at 6.5%. And the interest rate, as we had said, will follow close behind. Because what happens then is that to try and keep up with the inflation that is going up, the interest rate then got increased to 9%. So, January 2022, inflation 5.7%, interest rate is sitting at 7.5%. And we're talking about the prime lending rate at this point. July 2022, inflation rate is sitting at 6.5%, and the interest rate is now at 9%. So even if you were to check now, and you can do the quick Google search, if you check the inflation rate right now for November 2022 versus what the interest rate is, because remember, we've just had an interest rate hike again, you may see another relationship in terms of the inflation rate is going up, the interest rates also go up. But what does it mean when the interest rate is up? When the interest rate is up, basically, number one, it means that borrowing has become slightly more expensive. So, why do we say this? And I'll give you an example. I borrowed money to buy a home, my bond. In, I think, May 2022, my bond was 17,800, right? Then the interest rate got increased over a number of times since May. Right now, on the same bond, I'm paying 21,400. So the cost of borrowing has also gone up due to the fact that the rate that commercial banks are giving their consumers, where they're starting is, so you remember we all start at a prime lending rate. The basis of the prime lending rate has shifted slightly up. So where banks would have, if we go back to January 2022, when it was starting at 7.5%, if a bank wanted to give you prime plus 2, a bank was going to give you 9.5%, right? If you go to now, where I think it's 10.75, if I'm not mistaken, if the bank gave you prime plus 2, it means that you are going to pay 12.75%. So that's how much they would calculate what your minimum monthly installment would be. So the problem with interest rates is when you increase them, you make the cost of borrowing higher. And what essentially happens is that a majority of people then go into a panic, they don't borrow, and then you reduce economic activity within your actual economy. So now people don't borrow. People are having to tighten up their belt because it's more expensive. All of a sudden, an apartment you were paying 9,000 Rand for in the beginning of the year, you could potentially be paying 12,000 for right now. So you've had to find money in your budget. You have to find money in your budget to be able to cover for this new increased minimum installment. So then the economic activity starts to slow down a little because it's expensive to borrow. So again, you then take away a purchasing power of most households. So again, that is why then inflation creates that rising cost of living for a lot of people. Because now, borrowing is expensive. Existing loans have become more expensive for people to be able to service. You've taken away a level of purchasing power from these people, and the cost of living is basically, so the relationship between interest rates and inflation essentially is what is going to create an increased cost of living. Right? Let's move on. So the increase in the cost of items, and actually I wanted to put this here just to again ask the question, what are some of the things that you have seen, like the price of oil, cooking oil? The price of cooking oil is shocking. The price of milk, the price of bread, the price of petrol. You know, during that invasion of Ukraine by Russia, when we realized that the shortage in terms of fuel that was coming to our countries was going to push up the prices of fuel, we even had to get the government to intervene to actually stop charging the fuel levy on fuel, just so that we could afford fuel as a country. So the increase in the cost of items is due to things like inflation, things like a rising interest rate. All of these things ultimately eat away at your buying power. And when you don't have buying power, you start to realize what is the real cost of items that you have or need to buy. So when do you consider and what do you consider to be able to ultimately measure the cost of living in your own pocket? Remember, we had spoken about using the CPI, the PCE, and the PPI to be able to measure inflation in general terms. But I think for everyday folk like you and me, we would be able to start seeing that no, man, the cost of living has actually gone up. My bond and borrowing costs have become expensive based on increased interest rates. The prices in the market of an average 2-bedroom apartment or renting out a bachelor apartment, they've gone up based on what is in the supply or what is in the demand. So remember, it's either a cost push or a demand pull based on an imbalance of supply and demand. You're seeing that even the taxis, the public transport guys, have taken out a memo to say they're going to increase their prices in taxi fare. The Gau train is more expensive. One of the things that we've also saw was when they grounded ComAir. So for instance, ComAir grounded Kulula, it grounded British Airways. If you look at the line to fly from Johannesburg to Cape Town, you will start to see that the prices have been adjusted, and the guys who have those flights, a majority of those guys who have the flights, have actually adjusted their prices because the demand is high, but the supply has not kept up because we've grounded 2 airlines that also had a path or a line between Johannesburg and Cape Town. So now you're starting to see, yes, it might not be a necessary expenditure for everybody, but flying is an expenditure that is real in most people's lives because especially moving from one city to another city. Cape Town is quite far from Johannesburg. So a majority of the people who need to commute between the two are reliant on air travel. Now, when the supply is low and the demand is high, there's an adjustment that happens in terms of the costing of those actual tickets. Healthcare expenses. I got sick, I think maybe 2 months ago. I got really sick and I needed to go to the doctor, but it was during the weekend. And so I tried to find out how much it would cost me to get a doctor to come and see me at home. When I got the pricing, it was 2,800 for a call out. This is before the consultation. Then it was another 1.8 for the actual consultation. This is before they give you medication. The cost of healthcare are indicative of the fact that the cost of living in this country has gone up. The cost of living in most countries has gone up. Taxes. Of course, we know that our taxes in South Africa are adjusted on a recommendation from the Minister of Finance at our budget speech. But you realize that taxes are also an indication that the cost of living in certain areas is expensive. VAT, for instance, value-added tax. We've had to increase ours from 14% to 15%, showing that there's been an adjustment in the cost of living in South Africa. So what are some of the things that contribute? We saw again during Ukraine, rising energy and petrol costs. We saw also not only that, but shortages, cars. Most dealerships did not have cars. They didn't have models. They couldn't bring in new cars into the country. So what they've got on the floor, they have to sell that. So they adjust the prices of those cars. Shipping costs, rising wages, climate impact, trade barriers, supply and demand. And from you personally, changing jobs, buying a more expensive car, having a baby, a life change in your life, a lifestyle change, getting married, having a baby, your child moving from high school to university. Those things are real life changes that will contribute to a rising cost of living in your own personal home. So I want to ask you again, what has been maybe something that has changed in your life that has obviously changed the cost of living in your personal household? What are some of the things that have happened? Have you had a baby? Congratulations. Have you gotten married? Again, congratulations. Your child has graduated from nursery school and now they're going to grade 1 and you're now having to deal with primary school costs. Congratulations. And often it's the things that we congratulate, right, that are happening in our lives, that buying a car, buying a home, that actually contribute to the rising cost of living in your own personal home. So all of these things are quite key because they essentially get you to a point where you're like, uh-oh, I now need more buying power. Going back and just recapping on the relationship between the cost of living and inflation. What you spend on your daily to be able to maintain the quality of life. So what happened with a lot of people is that when you ask them, how are you dealing with the rising cost of inflation, of the rising cost of living? A lot of people have said, I now have to check my groceries. I now have to check what I buy. I no longer have a big available disposable income because interest rates have been hiked up. So when I used to have 2,000 Rand that I could save in my pocket, now I can't because that 2,000 Rand has to make up for this new monthly installment that I have to pay. So if you're moving from 17,800 to 21,400, it means that that little bit of disposable income that you had and you could use to buy things is now no longer available to you. Do you get it? So the relationship between the cost of living and inflation is not one that we should be taking lightly. It's not one to be taken lightly, and that is why it's actually important that you yourself have and use that inflation psychology. So what did we talk about? The 3 factors that cause inflation is demand pull, cost push, and expectations that one can have about what will happen with inflation in the near future. Because if you can kind of, like for instance, I say, there's a forecast that the interest rate is going to be hiked up even further, right? So we're saying if indeed the interest rate does get hiked up, it means that you are going to be paying even more in the next year. So there's a forecast or a prediction that it can go as high as 11%. Now, if it does go to 11%, it means that you will be paying at least 25 basis points more than what you are paying right now if you have a flexible rate. If you were to take out a loan next year, Jan, it will cost you more on that loan than what it would have cost you if you took out the loan this year in the beginning of the year. So these are some inflation expectations that one can have. Because if you are seeing inflation rising up, you must know that there's going to be almost a following with the interest rate. So some of the central banks or some of the monetary committee policies or committees try to balance one or the other. They'll try to increase inflation here and there to try and manage the interest rate, or they'll do the other way around. But essentially, inflation and the interest rate mirror supply and demand principles. And if you understand that, it becomes a little bit more helpful for yourself to say, okay, even when I'm walking into my boss's office and I'm going to now want to negotiate next year's salary, I must already have a factoring in of what if inflation is adjusted? What if the interest rate is adjusted? This salary increment that you are giving me, it does not help me with the cost of living going into the new year. So it's very important to understand that. Because if you don't understand that, it's difficult for you to negotiate salaries. It's difficult for you to find investments that are going to give you a return that will beat inflation. Because some investments are not adjusted to the inflationary rate. So if you take up a 5-year investment where the return is potentially 6%, but inflation is sitting at 6.5%, your money is moving backwards. So it's very important then to ensure that these are some of the things that you are factoring in and you're remembering how and where they would work to be able to ultimately negotiate a little bit better for oneself. Right. Let's talk about where do you put your money. Always a difficult one. So I will premise it off with, I am not a financial advisor. If you are looking for financial advice, I would suggest sitting down with your wealth manager, your investment specialist, and speaking about where could you potentially put your money. Remember, the best financial advisor is an advisor that is able to see, predict, what inflationary rates are going to do, so that they help you put your money in places where you are going to beat inflation in terms of the returns that you're going to get, whether it's from a capital gains perspective, whether it is from an interest perspective. They need to be able to put your money there. So sometimes what happens is they put your money in stocks where you've got a dividend strategy, and just based on the dividend strategy, you are able to slightly beat inflation. So yes, we've seen that the stock market is in a bear market. Right now, I logged into my Easy Equities platform and I was like, oh, stock market is coming to recover now. It's coming for all of us and it's recovering. Of course, you can't predict the stock market, but it is starting to try and recover. People are still predicting a huge recessionary phase again in the beginning of next year. However, we know that if you take the stock market and you buy it with an approach of minimizing risk. So what do we mean when we talk about minimizing risk? We're talking about you buying, for instance, the S&P 500. We're talking about you buying a broad market index fund. We're talking about you buying a DV+. We're talking about you buying a Satrix Top 40. These are financial instruments that have grouped global broad market funds or indexes, right? And you are basically spreading your risk amongst, in the Satrix Top 40 South African JSE listed stocks. So instead of you buying a Sanlam, a Standard Bank individually, because we saw that there is a shocking drop in the prices of stock right now individually. But when they're together, the risk is spread across all 40. Now imagine if you're buying the S&P 500, the risk is spread across 500. So it's important to understand that while you are also investing, diversification is probably going to be one of your biggest fighters in terms of inflation. Bonds. Now everybody's like, yeah, but bonds are boring. And when the interest rate goes up, we don't get good returns in terms of bonds. But remember, they may offer lower stock, but they are safe in terms of beating inflation. Right? If you are a risk-averse person, or you are somebody that is potentially nearing a phase where you need to withdraw from your investment. So you could be in a space where you're going into retirement phase in your life, or you have saved up for a child's educational reasons or purposes, and your child is about to matriculate and go into varsity. And you now need that money to be taken out of whatever aggressive fund you were in and put into something a little bit more preserving in terms of value. You may want to look at a bond, for instance. Yes, it is going to offer you a lower return, but at least it's offering you a return. The next one, commodities, right? investing in commodity companies. Companies that produce, sell, trade gold, silver, platinum, stock, livestock, rice, wheat, the bigger and broader commodity space. Then the next one, of course, is real estate. We know that real estate is not just buying brick and mortar, right? Real estate, we're talking about real investment trusts. We're talking about property shares, commercial property shares. We're talking about property schemes. We're talking about real estate company, right? So a sound option to beating inflation may be to invest in a property company, in a listed property company or a REIT, but it also gives you an option to say, I want to tap into a physical property market. Because remember, you may already be in the property market, and when inflation happens and the demand for rentals, for instance, is high, but the supply is low, prices can be adjusted. So you slightly make a little bit more money if you can find the demand and you are in possession of a 2-bedroom apartment, 1-bedroom apartment, or a rental apartment. So that's one way of looking at it. But of course, we know that real estate accounts for more than just renting out homes and apartments. There's also retail property. Last week I was at an auction and I saw how people are investing in commercial property, fuel stations, commercial zoned land, blocks of apartments, parking lots. So there's quite a number of things that you can really put your money into because those assets hold value. And the volatility in those asset classes is not that high, that prices are just going to fluctuate up and down, up and down, up and down. And real estate is one of those asset classes where the prices are not going to just fluctuate just in chain. Some companies, because they have inflation expectations, they can raise their prices so that they can still make sales based on their competitors or where the standard is right now. So these are some of the companies that you can essentially invest in. So for instance, if you look at a South African situation, we currently have 2 major sneaker brands. We've got your Batus and your Drip. You could potentially be like, okay, if Drip adjusts its prices to similar to what Batu is, then maybe there is a case to buy into Drip or even to buy into a Batu. Because these 2 brands are almost like a monopoly in their industry, or at least a portion of the market in the industry that they're playing in. Yes, there are other brands, international brands like your Nikes, your Adidas, and all of those brands, but these are like your homegrown brands that share a big chunk of the market simply based on that story. So you may find that one may raise its prices to meet up with the competitor. So you invest in these kind of companies to help them keep their profit margins despite the rising costs, but your portfolio becomes more resilient during the times of inflation, especially when they are increasing their prices and potentially opening themselves up to a better margin in terms of their profits, right? So you could look at defensive sectors such as utilities, consumer staples, bread, flour, oil, milk, healthcare, telecommunication, because they are able to pass on costs to the consumers. And during high inflationary rates, they do a little bit better because, again, they allow for the profit margin to be slightly adjusted. And of course, foreign exchange. Forex means that you are buying and selling currencies. Now, what we do know is that if the price of goods and services goes up, the currency you are holding, it loses value over time because you might be holding 100 Rand that could buy 10 loaves of bread today. But if you bought that 100 Rand currency in the Rand form and you are holding on to it and inflation goes up And all of a sudden now, the 100 rand can only buy you 2 loaves of bread. It means that you have actually lost the value of the rand, ultimately. Now, to be able to manage this type of risk, as an investor, you need to look for returns that are far higher than the inflationary rate. So while you're buying currencies, you need to buy and hold and sell currencies that are going to have a return that is going to be far higher than the inflationary rate. But what makes a currency appreciate? A currency will perform well against any other currency if investors consider that currency or the issuing economy to be strong. And that is why all of the time you'll see economies like the USD or the United States of America, the Britons, the Europes of this world, they are perceived to have stronger economies. So what do foreign investors do? They pump their money into those economies. They want to buy investments in those economies. This means that it drives up the demand for the value of those currencies, therefore driving up the demand for those currencies. So if you are buying and selling, you may now, in higher inflationary rates, you may consider buying and selling a currency pair of 2 strong economies. Or you could look at it the other way around. But you could pair it up with a strong economy just so that you make sure that you are getting an interest rate or a return rather that is going to be higher than the inflationary rate. But what about gold? A lot of people love to ask, what about gold being a commodity? And many people do consider gold such an important inflationary hedge. But also keep in mind that the gold is also fashioned in the law of supply and demand. And that is why it can fluctuate in terms of its pricing, because it is dependent on several factors like movements of global currencies, policy choices by central banks, erratic supply and demand. So if government central banks decide that they want to change the gold policy, it throws off the law of supply and demand, or rather the balance of supply and demand for gold from a specific economy. And also remember, if you're going to be investing in gold, you've got to store it somewhere. And that costs money. Costs money. So very, very important to consider some of the investments that you're going to be investing in and ask yourself, how can they potentially beat inflation? So we've come to the end, or we're getting closer to the end, and I want to remind you again that supply and demand will affect the cost of living, because when the demand is high but the supply is low, the suppliers will almost determine the price. And when it's the other way around, it's similar. When the supply is high but the demand is low, and you are basically going to beg people to buy and purchase your goods and services, it means that the buyer is the one who's going to ultimately set the price. If there's 40 people trying to sell me a comb, if I go to another country and I've got a wig on and I forget my comb, and when I get there, there's 40 people who can sell me this comb, I'm going to buy this comb at the price that I want. Willing buyer, willing seller. But if I arrive in that country and I'm looking for a comb and you can barely find one, it happens when you get to the airport all the time. You get to the airport, it's a different country, and you want a SIM card. And obviously, many of the, I don't want to call them non-sophisticated countries, but in many countries, you may struggle to buy a SIM card at the airport, which means you don't have Wi-Fi, you're not connected, you are frustrated. So anybody that sells you a SIM card at that point can ultimately price it at whatever price they want, because the demand is so high. The amount of people arriving in that country are so many but there's only maybe one shop selling SIM cards. And you're sitting there and you're like, I'm so frustrated. I just want a SIM card. At this point, I'll pay anything. That is how supply and demand affects prices. And when prices are high, the cost of living also goes up. So that's ultimately how it works. So it's important to understand this. That's why you'll find that companies like Apple will use what is called a scarcity marketing strategy, where they'll push out a couple of new phones to a couple of influential people who will talk up the phone and how cool it is, but they'll make the access to that phone slightly difficult for people to actually buy it. Then people want it. They want it. We want this iPhone, want this iPhone, want this iPhone. Where can I get the iPhone? Scarcity mentality. Scarcity mentality. You may find that there's an oversupply of it, but because they want to rack up the price of that item, they will make it look like there isn't enough supply for the demand. So very important to understand, the law of supply and demand basically is the governing law for anything. But how do you manage all of this? It's important, guys. And we cannot stress it enough because it's going to happen in December. The spaza shops are going to do it. The bottle stores are going to do it. The retailers are going to do it. They are going to create a situation where system. You set up your bank account, you have a spending bank account, and you've got a transactional bank account for debit orders, for your life, for all of the things that you do, so that you can track how much money are you spending. Secondly, you got to make more money. Roman salads. Make more money. Additional income streams are now not a thing that we talk about. It's a luxury. It is now a basic. You have to have more than one income stream. Because we've seen that salaries are not keeping up with the rising in inflation, the rising in interest rates, and the other factors that will potentially pump up the cost of living. Carpooling, ride shares. There's no need for all of these cars to be on the road. It's not even good for the climate or the environment. Share. And you know, when you're carpooling, it makes you think about your trips. Because it's someone else's car. You ain't just going to get in someone's car and just like, hey, can we do a shop around? Or can we quickly go there? Can we quickly go there? No. You're in a carpool. You go from A to B. Done. Loyalty programs. Many of the supermarkets have loyalty programs, but some of us even forget the cards. Load them onto your phone. If you've got Google Wallet, Apple Wallet, whatever, you can actually load your cards and you don't have to carry them. Use those incentives. Use your air miles to fly. Use the likes of your e-bucks. Forget brand loyalty. You know, I once interviewed a young lady who works at an electronics shop and they received the goods. And I was so hurt to find out that the same kettle that is branded this brand is the same kettle that's branded the other brand. Like they just put the brand on and they move on with their life, but the kettles essentially are the same. Guys, it was the biggest shock of my life. Forget brand loyalty where there's no need to have brand loyalty. Reduce short-term debt. I just told you, a majority of flexible rate loans have gone up in terms of how much you're going to pay as a minimum installment. So whatever you can pay off, if you're getting a tax rebate, a tax refund, a bonus, if you really want to go into 2023 healthy and solvent, pay off stock cards, personal loans, revolving loans, pay those things off. Again, grow additional income streams, sell, offer your services, offer your time. People are going on holiday, babysit homes, babysit flowers, check up on people's homes, go water, do you get it? Diversify your investments. We spoke about a little bit about some of those investments. If you're looking to go into the stock market, for instance, instead of individual shares, buy your ETFs, buy your unit trusts. And probably most important, work with an accredited financial advisor. If you're going to make money moves, you want to make money moves with somebody that understands the market. We're going to do a quick quiz. I'm hoping that was valuable information for all of you. If you want, you can quickly go onto this website. It is called kahoot.it and play the quiz. Basically to test if some of the information that I've shared today was valuable to you. Did it make sense? Would you like us to add more to some of the stuff? Please leave it in the comment section so that we know what we want us to add on in terms of, more information on a specific area. It is obviously difficult to have a lecture or a masterclass on inflation and managing your cost of living in an hour's time. But without having to take any more time of yours, go onto kahoot.it. It's a simple quiz. I think it's 5 questions. Try out the quiz. See if you are starting to understand the law of supply and demand, how inflation works, what are the 3 inflation factors, how do you measure inflation, what impact will it have on the cost of your living, what is the relationship between inflation and prices, inflation and the interest rate, inflation and the law of supply and demand. All of those things will help you not only in this space, but when you're negotiating a better increase in terms of your salary, when you're negotiating or looking for better investments in terms of what return should I be expecting and will it beat inflation, in terms of thinking about what other inflation expectations one can have in the near future based on where we are seeing the economy going. If you are predicting an interest rate increase, it means that potentially inflation is also going to need to be increased. So I hope that you can try out that quiz. And then last but not least, if you are looking to join and start trading Forex, as I said, I am in partnership with OctaFX, and OctaFX is a global Forex trading platform, and they are absolutely fantastic in the terms that they give you so much information. They've got a basic video course that you can try out even before you start trading. Even before you go into trading, try it out. You learn about Forex, you learn about Forex concepts, you learn about the important things like your stop losses, your leveraging. All of those things are important so that you are able to do what we spoke about when we said you can use Forex exchange to be able to hedge against inflation. But for you to be able to do that, you need all of the information. So do go on there, learn a little bit about Forex, then jump onto actually downloading the app and using my promo code Nicolette100. It allows you to double on your deposit of however much you deposit so that you can actually start trading. I'm wondering if there are any questions that you guys may have for me. That is the end of my conversation with you. So if you do have questions, I'm going to try and catch them on a different platform. Let me just quickly open up my other phone to see what the comment section looks like and where I can pull some of your questions. It is a live session, so I'm not really sure how do I find your comment section here. But let's see. Where are the questions? I'm not seeing any questions. I'm hoping that if you do have questions, you can drop them in the comment section. I will be able to answer them at a later stage. Right now, I'm not really sure. I'm technologically challenged. I'm not really sure. I can see the stream, but I'm not sure where to find the comment section so that I'm able to answer some of your questions. But if you do have questions, please feel free to drop them into that comments box, and I will try my best to answer them. And where I don't have answers, I will find the right professionals to be able to answer some of those questions. But ultimately, I hope that I've helped you in finding ways to actually manage the rising cost of living, especially going into this crazy festive season. It's going to be crazy, but it's going to be mad fun. I think we've had a very hectic year recovering from COVID-19 and its impact on the economy, our currency values, our investments. So it is the right time to be able to buckle up now, but we will do absolutely fantastic. And I hope to see you guys on the next masterclass. And please, if you do have suggestions in terms of what topics you would like us to cover in these masterclasses, also drop them off into the comment section and we will attend to them. Thank you very much for tuning in. I appreciate all of your time. Remember, my promo code is Nicolette100 to double on the deposit that you're going to make it so that you can have a far more profitable trade on the OctaFX platform. I'll see you guys on the next one.